I believe the largest bust in world history is on the way. So it'll be the greatest opportunity of all time because, as you know, Kim and I made our riches between the years 2000 and 2008. Keep in mind the importance of numbers. Easing when it first came out. Ben Bernanke never said that it was K1, he just said that it was K because we weren't supposed to have a 23 and now infinity. But what happens is the economy gets addicted to it. So now the economy is addicted to stimulus government spending and therefore addicted to this money printing whatever you want to call it. So that's what the average investor needs to be cognizant of. Because they need to make changes to their portfolio as a result. If they don't, they're going to have a lot of financial problems in the future. That simply implies that there are more money units pursuing products and services in the economy. So there's more money in the bank. The dollar is phony money since it is nothing more than an IOU. And, to make it even better, extreme. All your checking account is the bank saying we owe you, I owe us. It's like a double I owe you, but they're creating more dollars. So it's just simple math. If there's more dollars out there chasing the same amount or fewer goods and services, most likely the price of those goods and services are going to increase. And if prices are going to increase over the next 10, 15 years, significantly, if prices go down or stay the same over the next 10 to 15 years, you'll need to restructure your portfolio significantly. The more I think about it, the more I think of it as false money. The Fed prints money, the rich get rich. You know, we have asset inflation right now. We have asset inflation in the stock market, bond market, real estate market, which really it's feeding the rich. So empty quality of even making the rich. Unfortunately, the middle class will pay higher taxes because the rich don't pay taxes. But what it does when you have a universal basic income and T for pork and pork, you know, so if you're a poor person, you can't afford a house now because real estate prices are so high, you know, and if you have a universal basic income, if you want to buy real estate, I don't think a bank will touch it. That's exactly how it is. What was life like back in the days of Rome? The circus and the bread. It appears like the stimulus checks and the UBI are doing the same thing today. People are getting a couple bucks in the mail and thinking it's terrific. At the same time, they are oblivious to the fact that they are being priced out of every single asset denominated in dollars. And if they do try to buy a house, or if they do try to invest in stocks or bonds, and if they don't know what they're doing, they're going to get steamrolled. Because everything is in a bubble, thanks to the Fed, the money printing the artificially low interest rates, and I won't accelerate them. That's right. It'll make the bubble so big it turns into a mania. You know what's interesting to you? Use the word mania, and we hear a lot in the media right now with this cancel culture where everyone is hysterical about everything else. But there's also a lot of hysteria in the stock market and all these asset classes. So it's like we live in this world where everyone is hysterical about something. It just kind of pick your poison. There's capital gains in this cash flow, and you gotta know what you're going for. So in real estate or in stocks, foreign bonds, people most of the time are going for capital gains. So when a person flips the house, is gonna buy it for 100, goes to 200, they're gonna net 100. But the trouble with capital gains is you pay tax on it. But the other part, there's always a boom and a bust, and I'm predicting the biggest bust in world history is coming. So it's gonna be the biggest opportunity of all times because, you know, Kim, and because we had apartment houses and our tenants were leaving to buy their houses, they couldn't afford. There was a thing called a ninja loan, no income, no work. I built our fortunes in 2008. So, there are booms, busts, and capital gains cash flow. And there's something called, you know, and the contrary is always true. I was at the gym just now before everyone else came out, and I remarked, I feel for this guy, and he replied, I've been a bus driver for 40 years, and I'm tired of it. Going to retire and I can't wait, you know, he's turned 65. I said, what do you got it? I got a 401k. I said, what's it filled with? He says, oh, I just sold all my stocks at the top of the market and I went into bonds. George, what did he just do? The most stupid thing he could possibly have done. First of all, you should never put all your eggs in one basket, but especially not the bond market right now with all the money printing that you referred to earlier. You know, Robert, before you said you think the market is going to crash. So whether that's the stock market, real estate market, the question is, does it crash in nominal terms or adjusted for inflation? See, the stock market can stay the same as it is right now. But if we get 10% inflation, because all the money printing you'll actually lose purchasing power, you see? So the market can crash up just as easy as it can crash down. If your definition of a crash is losing purchasing power. So if you're someone that believes like I do that once the Fed starts printing all this money, the government prints all this money with stimulus and whatnot, they cannot stop. It's like a heroin addict. The only thing they can do is print more and more and more. If they can't reverse course, then you need to start thinking through your portfolio in terms of hard assets, something tangible. Well, I'm an entrepreneur. But if the crash wipes out your business, you have no cash flow. And what happened when a COVID hit for Kim and myself? Cash flowing up, because the market was demanding more financial education. It's always going up and down, in and out, and that's what investing is. The capital gains, cash flow, boom bust liquidity, and all this stuff. And that's what financial education is. It's not this poor guy. He says I have a 401k. And I was told to sell all my stocks and get into the bond market. Now, George, would you explain why you said that is the most stupid thing you could do? Because you're getting a future stream of dollars. That's all a bond is. You're buying a bond for $1,000. And they're saying, okay, in 10 years we're going to give you $1,000 back, and along the way we'll pay. Do you have a smidgen of curiosity? It's insignificant at best. So, if we have a high rate of inflation as a result of money printing, you'll get your $1,000 back, but it'll just buy you a loaf of bread, so you don't get your purchasing power back, you only get your dollars back. When I look at the data, I'm interested in the relationship between stocks and equities and parts, and so the reason the stock market went up because they kept dropping the interest rates on the bonds. So when I started off, interest rates were about 16%. So if I had a bond, I was getting 16% interest. That was a very valuable bond. If they dropped the interest rate to 14%, my 16% bond was more valuable. That makes sense. Just like my cash flow from the bond or the dividend was good. And so when the market kept crashing, they dropped it to 8, and today on the long bond, I believe it is around 2.5. They had to keep cutting bond prices to keep the stock market up, and now we're at zero. The zero bound is what they're termed. That's right, and Japan is located there. Yeah, you can't keep reducing the bond price for a long time. The stock market comes down. So that's the correlation between equity, stocks, and bonds. So this is my question, Joyce. So let's say today bonds are 2%, what happens when it goes to 5% because inflation comes in? They have to raise the bond rate to 5%. What happens to the 2-year bond? The value of the bonds purchased at 2% goes down. Yeah, and that's what that guy did. That's right, he's buying a bunch of stuff with a value, you really can't get any capital gain on it. The most like you're going to be stuck holding, and that's not going to be good. And inflation. One of the great things about being an entrepreneur, going back to Rich Dad Poor Dad, is you put yourself in the position of being a price maker where other people are price takers. The majority of people are price takers, so they have to take whatever price is offered by whatever it is they want to buy. But the real estate owner, the apartment owner, let's say, or the business owner can raise their prices if the rate of inflation is going up. So it hedges you against inflation while at the same time paying you to own it with that positive cash flow. And a bondholder does not have that opportunity, to say the least. Bonds and stocks are liquid. Real estate is not. So it's like that guy buying a bond at 2%, nobody wants it if it's 5%. So if you buy a piece of real estate, let's say in Dallas, Texas, and suddenly the prices drop, it's hard to get out of that debt on that real estate because it's not liquid. So the good thing about the bond, he can dump and take his loss now, but real estate is the liquid, and that is why we strongly advise investing in financial education, as it is not a panacea. It's a process, and my fear is that, while I'm not saying don't buy because I was just in Texas, it's a craze because everyone is fleeing California and New York and wherever else they're fleeing to. Everyone wants to move out of the city and into the country, therefore they want a piece of it. Is it good or bad that land prices have risen now?